Today on Housing Horizon, Macro and Mortgage for June 2026, I'm your host, Van Hansen. I'm here with Joe DiGiambattista, Principal Mortgage Broker at Go Mortgage Co. Good morning, Joe.
Good morning, Van. How are you today?
I'm very well. Yourself?
Very good, thank you.
Great. So, Joe, this is our June 2026 update, and I want to start by framing what we're covering today.
Yeah, so we're going to be looking today at more of the economic principles behind what's happening to rates, primarily the Bank of Canada, and a little bit on the bond impact, which are all, a result of what's going on with the labor market, with GDP, with inflation. So we're going to drill down a little bit on that. We're going to take a look at what's going on with the marketplace a little bit, and just give you an update on rates.
Great. And so, Joe, before we dig into the data, let's flag the key dates people need on their radar. What are the most important announcements coming up, and why should someone about to buy or renew their mortgage care about them?
Yeah, so the key rates are important, the key dates are important. They're important because they part and parcel give us data around the metrics that affect interest rates. Recessions and GDP not performing well, or unemployment overperforming. Those are the kind of news headlines we've been seeing in the last little while. And we're just going to try to take a look at that and get a sense for what does that mean to the housing market? What does that mean for consumers?
Great. And if we can go to the next slide there on inflation.
Yeah. So just to recap before we do that real quick, inflation is the next announcement is going to be on June 22nd. We were up from 2.4 in April to 2.8 today, which still is a moderately low increase, especially with seeing what's going on with the U.S. They are up to from 3.8 to 4.2. So our next announcement is going to be June 22nd in about a week. We think inflation is going to be working with us and not an issue, so we're excited about that, which should have a probable impact on July 15th of no change. And there's been no change since October 2025. And that's kind of the sense we're going to get, that we don't expect the variable rate to change much, depending on what the data looks like over the next 6 months. So if we take a peek at inflation first, you can see that inflation is in good shape. We've had an impact of 19.2% to energy, yet the overall numbers, CPI trim and CPI medium, are 2 and 2.1. So headline inflation is up to about 2.8. Core inflation is still down to like 2.2. Our target is 2. So I think that considering everything that we've seen in terms of the impact of energy costs and potential tariff impacts, we're still doing very well from an inflationary standpoint, which means two things, which means the economy is sluggish, right? So and as a result of that, people are spending less. So we're not seeing that spending, and we're not seeing that impact to the market economy. And a lot of that has to do with the fact that we have a lot less people in the country that we were letting in this year and last year compared to 2 years before that.
Okay, great. And so there seems to be two versions of inflation. There's the headline number that gets the news coverage, and Bank of Canada's own core measures. Can you explain why the bank seems to care more about the core measures and how that translates to what's the data telling us?
Yeah, so they care about both, but the impact to headline right now is energy. So headline inflation takes into consideration everything, including gas and food. Core inflation strips out gas and food. Food I'd be a little more concerned about, but the fact that they're stripping out the gas, that means that 19.2 on the left side of the screen, it gets removed. And that's why our trim comes down to 2.1, because we're not using that 19.2. And because we believe the war is a situational occurrence, and if it's resolved, and it seems to be getting resolved, then that cost of energy should not find its way into the supply chain. And if that cost of energy just does not find its way into the supply chain, then it suppresses inflation. And so on the next chart, we can see that we have indicators, though, And this is important, right? If we do not end this war, then we will see that inflationary impact of energy costs affect industrial product prices and raw material prices, which are part of the supply chain. So they're already up 11.4 year over year on the industrial product, and we're up 32% year over year on raw materials index. Yet core is still at 2.1 or 2.2, which is a good thing, right? So if we can end this war now, if this peace deal gets put through, then we might not see that impact to future inflation because of the supply chain won't be affected.
Right. And can you maybe explain what the IPPI and the raw materials index are, and why a number like 32% year over year matters for homeowners?
Yeah, so it's really just what it means is we're seeing energy prices getting embedded in industrial product and raw materials earlier in the stage. So the first thing is energy prices go up, then people that produce the goods and services that we buy get impacted by those costs of energy prices being impacted. And then those raw materials and industrial products get moved into retail and wholesale scenarios. And if they're increased because of that supply chain impact, then you see inflation affecting all product. So that's why it's important that we get this war over with to make sure that these product prices don't increase.
Okay, thank you. And next, the word recession gets thrown around a lot. And before we look at the actual gross domestic product numbers, can you walk us through what a recession actually means? Because there's obviously a big difference between a technical recession and a full-blown one. And I think a lot of people conflate them.
Yeah, so the technical recession is, again, this is just something that's newly being used in terms of language that we've seen in the last 5 or 6 years. And all it really means is let's deal with a full-blown recession means you have two negative back-to-back quarters of production. So zero is our benchmark. Anything above zero means the economy is performing at a profit. Anything below zero means the economy is struggling. If you have 2 quarters below zero, it's a full-blown recession. What they're saying is a technical recession is inversely, is that if we have 2 quarters where we decrease GDP, yet they're still above zero, then that's technically that's called a technical recession. So we haven't gone below zero for 2 quarters. I don't think we've gone below zero for 1 quarter, but we've seen the market pull back for 2 quarters, and they're calling that a technical recession.
Okay, thank you. And Joe, next you've got an economics forecast table for us, and it's packed with information. Can you walk us through the big picture? Why does the gross domestic product trajectory, what does it look like for Canada in 2026? And what does that mean for people wondering whether now is a good time to buy?
Yeah, so I think we have to look at all 4 of these numbers together. And when you look at the GDP number at Q4 2026 being 1.5, but for the entire year of 2026 it's 0.6. That means that this year is going to still be a little bit of a struggle. And I think that struggle for this year is 100% related to uncertainty. Uncertainty with energy costs and uncertainty with the tariffs. But the RBC in this instance is suggesting that we're going to move through that through 2026, and we'll get into some growth back in 2027 at 1.5 GDP, which would equal what we would see a good Q2 and a Q3 in 2026. So we're going to get some momentum starting now in GDP, and we expect that momentum to continue on into 2027. So that's positive. And as a result of that momentum in GDP, we're seeing a nice steady decline in unemployment. We saw it get up to 6.9, then it came back to 6.7. Q3 they expect at 6.5, Q4 at 6.3, and then we run all the way over to 2027 at 6. So our employment rate is going to drop from 6.9 in 2025 to 6.5 to 6, which means more people working, more people spending money, more people in the economy. That's the impact of first-time homebuyers, is that there's more fluidity in the marketplace. It's moving. It's not staying put. It's not stagnant. And then during that entire process, if we start to see that spending go up, that unemployment go down, that GDP come back to normal, that is going to be a little bit inflationary. So our Q4 inflation number of 1.7 is going to edge up to 2.3 in 2027, but still be at 1.8 in 2026, which means if we do not see the inflation numbers, if we see these inflation numbers and we see GDP struggle, we could see another variable rate drop. Right, so I would be more bullish on a rate drop than I would be on a rate increase, because I think the inflation numbers are being managed, and I think we're still going to struggle economically throughout 2026 before we get better in 2027, which could encourage the bank to drop the rate to incentivize people in investment in Canada. So I think that's all good news. And if you look at the bottom line, you can see our key interest rates are scheduled to hold all the way through 2026 and then get into a little bit more increase in 2027. And again, why would they increase 1% in 2027? Well, really, it's because people are spending more or to incentivize the economy. So that's good news that it's not good news rates could go up, but it's good news that the reason rates would go up is because the market's back. Which means that, we might have 12, 15 months left of a buyer's market in Ontario. And then that could shift potentially to a balanced market as those numbers get more corrected in 2027. So that could be the impact to consumers.
Right. And there's this bottom line you're talking about here, the key interest rates. So with forecast, flat at 2.25 all year, and then a hike to 3.25 in 2027, which is it's a meaningful jump. What's the implication for someone choosing between a 3-year and a 5-year fixed term right now?
Yeah, so the difference right now between we got the rate sheet coming up, so I'll talk a little bit more about rates when we get to the rate sheet. But I think what we're seeing today is we're starting to see a gap be created between the variable and the fixed. So for if you go back 25, 30 years, the variable has always been lower than the fixed. And then you get to the COVID era, and after the COVID era, the variable rate was higher than the fixed. So we're coming back to some normalcy in the marketplace where we're seeing the variable rate below the fixed. And when the variable rate and the fixed rates are close together, it makes more sense to take the fixed rate because there's no incentive to gamble on the lower variable. But now that spread between the variable and the fixed is getting larger. We're seeing 50, 60, 70 basis points potentially difference between the variable and the fixed. So that gives us the ability to take advantage of the lower variable rate, keep an eye on the marketplace, because anytime you're in that variable rate, you can flip to a fixed rate with no penalty. So you can lock it up. You just want to lock it up before rates go up. So you have to stay in tune with the marketplace. So with the fact that the variable is down to 3.5 in some cases, you can get a lot more purchasing power. So people, have a double whammy here. They have a double win. They're going to be able to get more house because the rate's at 350 on the variable, and they're going to get more house because house prices have dropped 15, 20% in the last 2 years. So it's a pure buyer's market. If you're a first-time home buyer and you've got some money, if you do something in the next 6 months to 8 months, you're going to be getting more house than you would have got 2.5 years ago, and then you'll probably get in 2 years from now.
Right. Thank you. And so the May jobs number was genuinely strong, 88,000 net new jobs and 154,000 full-time positions added in a single month. But you're also showing that year-to-date unemployment is still negative. So how do you square that headline? Is this a turnaround or a 1-month blip?
Well, Q1 was bad, right? So I think that's how you turn it around. Q1 was a rough quarter. So I'd be more interested to see what happens going into Q3 with the monthly indicators. So next month's unemployment numbers are going to be real. And if we see, I don't expect we're going to see this kind of growth again. But if we see growth, if we see unemployment being maintained, I think that's a very good sign that we're managing through the tariff noise and we've managed through the war. So I think there's opportunity, and I also believe that if we did resolve the issue with tariffs with the U.S., unemployment would be a non-issue. If these are numbers that are a result of an economy that is not seeing an investment from corporations, right? So right now, Canada's kind of been held back in terms of investing in the country because of the uncertainty. Yet we still had this kind of growth. To put it in the context, I think we had 154 full-time people last month, and I think the U.S. had 172. Right, so they had about 25 more than us, and they're about 350 million more people. So we had a really banner month. So it's going to be interesting to see what this month comes up with and looks like, and that'll get a better sense of whether this is blip or trend. But it's good news, man.
It is, yes. Thank you. So on to the Bank of Canada announcement. So the Bank of Canada has held at 2.25 since October 2025, 5 consecutive pauses. And you've got an excellent quote I see on here. Governor Tiff Macklem, economic weakness combined with rising inflation is a dilemma for monetary policy. Raising rates to dampen inflation could further slow the economy. Can you unpack that quote for us a little bit and tell us what it means in plain language for Canadians that are watching their mortgage rates?
Yeah. So if again, we've been talking about it a few times, and it's important that we continue to talk about it to make sure the message gets delivered. If we have inflation as a result of the war, yet the economy is holding its own, then they may increase interest rates to keep inflation at bay. If the inflation it gets resolved, if we don't see growth in inflation, and the economy holds the course, then we're going to continue to see flat rates. If inflation continues to hold the course and the economy suffers, then we could see a drop in variable rate. So this is really, we're just talking about variable rate. Inversely, on the fixed side is based on the bond market. And when you have times of uncertainty, and in the US, times of higher inflation, then the bond market says, you know what, if you want me to put my money into fixed bonds, it's a little bit more volatile right now. There's a lot of US debt out there. You got to pay me a little more. So until we see some more stability in the markets, I think you're going to see fixed rates edge up and down 5 or 10 basis points either way, depending on what the bonds are doing. But right now, the bonds are a little unsettled. They've come back maybe 5 basis points in the last week. But they've been on a trajectory for about 60 days. So I'm hoping that we see some of that pressure on fixed rate reduce, but I don't see any upward pressure on variable rate at this point.
Okay, thank you, Joe. And then our next slide is on bond yields. So, I think this is a slide that buyers and mortgage renewers need to really understand because there's a common misconception that if the Bank of Canada moves, mortgage rates follow. But fixed rates are tied to bond yields, not the overnight rate. Can you explain that relationship and what the bond market is telling us right now?
Yeah, so the bond market, if you look at May 26th to June 26th, is going up, right, on the slide on the left. If you look at the slide on the right, where it compares the variable and the fixed, you can see that period between 2022 and 2025 where it was inverted. The orange line is higher than the blue line. That's not normal. You go back to 2015 to 2022, the blue line is traditionally higher than the orange line. And when you go to 2026 at the far right, you can start to see now that orange line is starting to build that gap. That gap is starting to spread between the fixed and the variable. That's the advantage of the variable. That's the benefit of the variable, right? And if you're in the marketplace, my recommendation 100% is look at the variable. If you have some room in your cash flow and can absorb a bump if you get caught, look at the variable, because if you keep an eye on the marketplace and we get a sense that those bond rates are going to continue to move, then at any time in that variable term, you can convert to a fixed rate with no penalty. So it allows you to get into a bigger house, a better house today by leveraging the lower variable rate, and then you can convert to the fixed rate to protect your payment once you close the house.
Okay, thank you. And Joe, let's bring it home. So the next is the rate sheet. If you can walk us through what's available right now across insured and conventional and non-income qualified products. Where's the value and who does each option suit?
Yeah, so if you look at it, it's exactly what I was talking about, right? If you see the 350 on the insured, the fixed is anywhere from 411 to 434. That's 60 to 80 basis points, right? That could be the difference of an $80,000 or $90,000 mortgage amount on what you're buying. So there you get a lot more purchasing power at the 3.5. And when there's that kind of a spread between the variable and the fixed, and there's almost an incentive to take the variable and either write it down or write it up. But don't write it up when it starts to move up, convert to the fixed. On the flip side, in the conventional, it's the same deal. There's a conventional 3 years at 419. The 5-year VRM is 375. Again, that's about 40, 50 basis points. The conventional 5-year closed 30-year M uninsured is at 459. That's 80 basis points higher than the variable. So there's some strategic thinking here. So you got to manage the biggest dollar for your value based on the interest rate, but you got to also manage what your risk tolerance is on the payment side. So that's kind of what we work with when we talk to clients and making sure they understand the difference between the two. But the rates right now are still decent. They're 2.5% lower than the peak. So there's a lot of purchasing power out there. The non-income qualified is still great for 489. So just to put that into perspective, the conventional 5-year bank deal at 30 years, 459. You got to declare. You only get qualified on declared taxable income. On the non-income at 489 for 1 year, you can use gross income. You don't have to use what you declare as CRA. And that's only a 30 basis point difference. So what that means is on a $500,000 mortgage, it's $1,500 more a year. But on a $500,000 mortgage, you need to declare $100,000 in income. That means you're paying about $30,000 in taxes on it. Which, if you're self-employed and you use gross sales numbers and you declare $20,000 in income tax, you're only paying $4,000 or $5,000 on that. It's a much bigger difference. So the lowest rate is not always best for the consumer. You got to manage the lowest rate in cooperation with what your tax liability is, and then take what's going to get you the net best revenue in your pocket.
So our next slide on market activity, it really puts the rate conversation in context for what's happening in the housing market. What story are you seeing across these cities?
Yeah, so when the market, Toronto gets impacted first and foremost more than the rest of the country, Toronto and Vancouver. And then when it starts to rebound, it's the first to come back. So I'm not saying the Toronto market's finished with its challenges, but I am looking at this stat for April that says Toronto is the only city that saw home resales grow by almost 10% in April, and listings drop by almost 10% in April. So if that is blip, we'll catch it on the next report. But if that's trend, you tell me, man, what happens if we continue to see houses sell and we don't replace them with listings?
Well, the market swings to a strong seller's market.
And that usually means prices start to move up. So again, I'm not saying that's going to happen in Toronto, but I'm saying this Toronto listing activity, I haven't seen in 2-3 years. We haven't seen resale shoot up and listings shoot down. Right? It's been inverted. Resale's been forever going down a little bit. Listings have been popping up a little bit. So to see this graph kind of gives me a little bit of a good feeling in terms of what could be coming our way if Toronto continues to perform in this marketplace.
Great. Thank you, Joe. And this has been Housing Horizon, Macro and Mortgage for June 2026. I'm your host, Van Hansen, here with Joe DiGiambattista, and we will see you next time.
Thank you, sir.
Thank you, Joe.